when it comes to China, the data is really becoming more and more supportive of a bifurcated recovery, and perhaps one that in some respects won't be as sustainably strong going forward. Is that the lens that you're looking at this economy in, and how are you finding the opportunities?
Well, certainly the recovery is very consumer focused, that's true. We were not really expecting property construction, for example, to contribute to recovery this year. But the consumer is extremely strong. We're just going through the Golden Week process, and domestic travel is up in terms of trips taken about 20% on 2019 levels. And though there's some variety in the way that consumer companies are reporting, it's very clear that the Chinese consumer is back and out in force. And we still have a lot of confidence that by the fourth quarter this year, we'll be looking at something like 6% year-on-year growth. And that's in stark contrast to what's going on in the US, of course.
In terms of how you find those, I guess beyond the low-hanging fruit, right? What are you looking for when it comes to equities growth, when it comes to the Chinese markets, and which of the sectors that perhaps are yet to benefit from the next legs of that recovery?
Well, we think the market as a whole in China has cheapened up again. It rallied very hard over 3 months to the end of January. At one point, it had outperformed the S&P by over 50 percentage points off the bottom. That's narrowed subsequently. But you're down now across the market, really, in China to low valuations, sub 10 times forward PE. Broadly, we like consumer services, e-commerce, internet, tech hardware-related names. We're quite light across the region, in fact, not just in China, on energy, upstream energy, and also on diversified miners. We've been quite cautious on the iron ore price, for example. So we are really trying to play this mostly through the consumer.
We saw Chinese equities earnings actually missing when it came to the last quarter of last year. Do you expect this to actually improve?
Yeah, so the way that this typically works is that stock prices anticipate earnings cycles sort of 6 to 12 months out. So given that stock prices troughed in China and the rest of the region last October, it's really crucial that we do see earnings recovery in the second half of this year. And we have a high degree of confidence in that with what we're actually seeing on the ground. And outside of China, of course, we've got this broad situation in semiconductors and technology hardware, where the firms are adjusting production. Inventories are starting to fall back, and we think fundamental demand will build up through the next cycle through 2025. So it isn't just China. There's also, for this region, a very important turn in the cycle in semiconductors more broadly.
Are we talking about Korea and the likes of Taiwan as well?
There are other two major overweights, and we're funding those through a more cautious stance on markets in ASEAN, Middle East, and Latin America, all of which are typically late cycle performers and did quite well through the course of last year. So we made this wholesale change last October, and so far so good.